Hello and welcome back to the next video that we have here covering job order costing. So continuing with where we left off, we talked about how to calculate cost of goods manufactured. We take the cost of our beginning with, and remember what I mean by cost, is materials, labor, and overhead plus any additional materials, labor, and overhead that we incurred during the period minus the materials, labor, and overhead in ending work in process. And then that gives us the cost of the goods that we did make. And again, that's similar to the example that I said. $5 to start the night, you drew 50, you had $10 left over. How much did you spend? Okay? And so we look over here, cost of goods sold, we'll continue on, is the cost of the completed units or products sold during the accounting period. Okay? And similar to cost of goods sold, we take our the cost of our beginning finished goods. Remember, that's equal to our materials, labor, and overhead, plus the cost of goods manufactured. So in order to calculate cost of goods sold, we first have to calculate cost of goods manufactured because that's an input to calculate cost of goods sold. So we take the cost of our beginning finished goods plus our cost of goods manufactured minus the cost of our ending balance in finished goods. If we look over here, we can look at our schedule of cost of goods manufactured. And on the next page, I have the income statement showing the cost of goods sold. So we look over here, we have our beginning WIP plus our additional manufactured costs right over here, materials, labor, and then our overhead. This gives us the total, and then we subtract out the ending. This is the cost of goods manufactured. And then what you can see on the next page is that number, $2,140,000, the cost of goods manufactured, comes over here to calculate on our cost of goods sold. So we have our beginning finished goods plus our cost of goods manufactured minus our ending finished goods gives us our cost of goods sold. Sales minus cost of goods sold gives us our gross profit, less our period costs, our selling and admin costs, gives us our net operating income. Okay? So the next few pages I'm just going to go over pretty quickly, or this page I'm going to go over pretty quickly. So again, this kind of just gives another example of our schedule of cost of goods manufactured, and then our schedule of cost of goods sold, which is, you can probably see it a little bit better on the prior page. This is just another example. Okay? So let's go on and talk about our problem 1 for our Henderson company right over here. And let me just catch up on my side over here. We look, and we're going to go ahead and do this problem. It says the following facts are known for the Henderson Company. We have our beginning finished goods, plus and then our ending finished goods, our beginning WIP, our ending WIP, our materials, beginning, our ending materials, materials that we purchased, our labor that we incurred, and then our manufacturing overhead. Now I'm going to say applied. Okay? Applied during January. Okay? Applied here. So for the cost of goods manufactured and cost of goods sold, find it, calculate those by completing the T account. So we're going to do some T accounts and kind of look at this a different way. Okay? So remember with T accounts, we put our debits on our left and our credits on our right. And with raw materials is an asset. So which means that normal balance should be on the debit side. Same thing with WIP, same thing with finished goods. So the normal balance is always on the debit. So debits would be the increases to raw materials, credits would be the decreases. Debits are increases, credits are increases, debits increases, credits decreases. Okay? So if that doesn't make sense, remember, if you watched one of the intro lecture videos that I had covering the basics of debits and credits, this is our accounting equation with our debits and credits overlaid on that. So remember, the way to increase an asset is with a debit, the way to decrease an asset is with a credit, the way to increase liabilities and equities with a credit, the way to decrease liabilities and equity is with a debit. And of course, the 4 things that affect equity, we can say plus revenues. Revenues increase equity, expenses decrease equity, owner investment. Okay, owner investment, that increases equity, and then we can say owner withdrawals, that decreases equity. Okay, that's why expenses are recognized with a debit. That's why owner's withdrawals are recognized with a debit. That's why revenues are recognized with a credit, and that's why owner investment is recognized with a credit. Okay? Because it increases or decreases equity. Okay? So now that was a quick review. So now let's go ahead and look at completing our key accounts right over here. So if you look over here, this 12,000 are materials. We start out there. That's going to go on the debit side because it's an asset. And it says I purchased, that's my beginning balance. I purchased 13,000. And then what I can do is I can draw my line and show my balance of 9,750. And then what I can do is calculate, I have to have a credit here because I had 25,000 of available raw materials and I only had 9,750 left over, which means I can take my 25,000 minus my 9,750, and when that gives me is 15,250. This is my credit. By taking the 25 minus the 9,750, 15,250, this is my credit to raw materials, which is the raw materials that were used during the accounting period. Now the question becomes, where do those raw materials go? Okay, but we're treating all these raw materials. Let's assume these are all direct materials. None of these are indirect materials because if they were indirect, some of them would go on to manufacturing overhead. Okay, but we're assuming that these are all direct materials. So that means they're all going to go into work in process. Okay, you look back on that figure that we went over earlier in the second lecture video, talking about cost flows. Look back at that if you don't recall what I'm saying here. Okay, that doesn't make sense what I'm saying. So if we look at our work in process, we have a beginning work in process of 8,500, and then I have what I have is my materials used of my 15,250, and I have my labor of 6,000, and then I have my overhead over here of 4,000. Okay, and then what I have is my ending WIP of 7,000. Now I can do the exact same thing that I did over here with my raw materials to figure out my credit. I can add up all these and subtract 7,000, and what that gives me is 26,750. Now the question becomes, this is the credit to work in process, but what is this? If you were to put a label on this and tell me what it is, this is cost of goods manufactured. How do we know that? Beginning WIP plus additional manufacturing costs incurred minus ending WIP gives us cost of goods manufactured. Now where does that cost of goods manufactured go? It goes over to finished goods because once we finish producing the goods, it moves from WIP into finished goods. So now we can look over here at our finished goods. And then what we have is our 18,000 beginning plus our 26,750 COGM. We have 11,000 ending. Beginning finished goods plus cost of goods manufactured minus ending finished goods comes over here and it gives us our 33,750. This is our cost of goods sold. Beginning finished goods plus cost of goods manufactured minus ending finished goods gives us our cost of goods sold. Now what we're going to do is we're going to do some journal entries. We say, assume that the company sold the goods to a customer for $48,000 cash. What are we getting? We're cash. Where do we put cash in terms of the accounting equation? Cash is an asset. How do I make an asset go up with a debit? So therefore, it's a debit to cash. And then, so I have to do two journal entries, one to recognize the sale, which I'm doing now, for $48,000, and then I'm going to credit sales for $48,000. This is the price that I sold it for. Okay? That's the first journal entry to recognize the sale. The second journal entry that I have to do is to recognize the cost of goods sold. Well, what's my cost of goods sold? It's $33,750. Where do you put cost of goods sold in terms of the accounting equation? It's an expense. How do I make an expense go up? Well, I make an expense go up with a debit because as expenses go up, equity goes down. So I'm going to debit cost of goods sold, COGS, debit cost of goods sold, for my $33,750, which is my cost, and then you can see what's going to happen, right, is it's going to be a credit to finished goods. Finished goods is an inventory account, which is an asset. I'm decreasing my finished goods because I no longer have them. That's why I credit finished goods, because I don't have them anymore. Okay? I sold them to somebody else. I don't have that inventory. So I'm going to credit finished goods for the $33,750. Okay, move that up, sorry. For the $33,750. And then, of course, the difference between the $48,000 and the $33,750 is our profit. Okay? So now on the next page, I have a few quick check problems. Why don't you go ahead and tackle these, and then we'll see how you do. Okay? you want to pause the lecture video and come back, that'd be great. All right. Well, welcome back. We come over here and we look at these problems. It says we have our beginning raw materials inventory was $32,000. During the month, we added 276, and then the count revealed that we only had 28,000 of raw materials left over. What's the cost of the raw materials used? So I come over here and I take my 32,000 plus my 276, right? That's how much I have on hand, minus my 28,000 that I didn't use. That must be the cost of the materials that I did use. And it's not the amount of materials purchased that goes into WIP. It's the cost of the materials used. It's not the cost of the materials purchased, but the cost of the materials used. So when you do the math, we get 280. Okay? This one is asking you to calculate cost of goods manufactured. So you take our beginning WIP of 125 plus our 835 additional costs minus the 200,000 of ending WIP. And when you do the math, you get C 760. Okay? And I hope you got those two right. Let's go on and talk about types of costing systems right over here. So when we talk about those types of costing systems, we talk about job order costing and process costing. And then remember, these are those two types of product costing systems. So the first one is we're going to talk about job order costing systems, which is used when a firm makes unique products to customer specifications. Okay? Unique products to customer specifications. Okay, that would be an example of our job order costing. The other thing about job order costing is we track costs by job. Okay? I'm going to switch pens over here. Just because I'm running, I can tell it's running a little bit low. So let's make sure that it seems to work a little bit better. Okay? Examples of companies using job costing systems, we could say a construction or home construction company. We could say a law firm, consulting company, we could say a shipbuilder. Okay. We could say an auto repair shop. Okay. So when you go in to get your car fixed, right? What do they do? They show you the bill for the car and they say, well, here's the parts, here's the labor. They don't show you the overhead because what they do is they typically mark up the labor to cover their overhead. But they're tracking the cost by fixing your car. Your car is the job. Okay. Now, on the other hand, a process costing system is going to be used when a company makes similar or identical products. Okay? That's the first characteristic. The second characteristic is that products go through a uniform and continuous production process. And then the final characteristic over here with process costing systems is that we track costs by department. Okay? When we look over here and we talk about some examples, we could say a paint manufacturer. Okay? We could say a soap manufacturer. And then finally, what we could say is also a cement manufacturer. And let me just talk about the paint one, or I'll talk about the soap one, for example. Yeah, there's different types of soap, there's different types of flavor, but it's still soap. And so that's what I mean by similar, identical product. Okay? Versus an auto repair shop. These are very different situations. One person could need a Virginia State inspection. Somebody else could need their muffler repaired, and so the costs are going to be very different. But the cost to make lavender soap versus vanilla soap are probably pretty similar. And so we'll talk more about process costing in Chapter 3. Goodbye.